Up until today, it has been a bloodbath out there, but this is exactly where traders are made. Welcome back to Triple Threat Trading, Episode 9. Today is March 9th, 2026, and the tech-heavy Nasdaq 100 is currently caught in a vice grip between geopolitical shocks and some truly ugly economic data. We are currently underwater on our TQQQ shares. Volatility is through the roof, and we have a massive decision to make regarding what strike price to sell our calls at tomorrow. I'm showing you exactly how I'm managing my $200,000 wheel position when the market tries to pull the rug. Let's dive in. Before we look at our trades, let's have a look at the why. What are the four stories that are moving your money this week? The first one is the Iran conflict. We are entering week 2 of the war. Oil prices have rocketed past $110 per barrel. For tech, this isn't good. High energy is a tax on growth and a fuel for inflation, so this is going to be negative on the market. Number 2, the jobs report. This was a shocker. We lost 92,000 jobs in February. The market expected a loss of about 50,000 jobs. Unemployment is up to 4.4%. This is not great news. And typically when there's not great news, the Fed will cut rates, but it's mixed. Like, we don't know what they're going to do. It might have to do with what happens with inflation this week, but we'll see. Number 3, we do have a couple earnings giants that are reporting their quarterly reports this week. Oracle reports on Tuesday, Adobe on Thursday. This is going to kind of let us know what the AI vibe is. Are we seeing real returns, or is AI fatigue setting in? We'll kind of see. And number 4, the inflation double whammy. CPI reports on Wednesday and PCE reports on Friday. These are final data points before the Fed meets on March 18th. If inflation stays sticky, say goodbye to rate cuts. So if inflation doesn't come down and it stays about the same, or it even goes up, we're probably not going to see rate cuts when the Fed meets on March 18th. So we'll see what happens. So let's talk about the strategy moving forward. One, we want to escape the $53 strike trap. So let's talk about that. Let's talk about our position. Currently, we were assigned TQQQ at $55, but with the Iran conflict and everything else that's been going on, the prices dipped to around $48, $49. We are 12% underwater. Now, I've been selling the $53 calls to collect bigger premiums, but have we hit a trap? Let's take a look at the math. If TQQQ rallies to $54 this week, which is well within its expected 10% move, I get assigned. I'd be forced to sell my 3,800 shares at $53, locking in a $2 per share loss. That is a $7,600 hit to the principal. Given TQQQ's volatility, the expected move is plus or minus about 9.8%, or roughly about 10%. A 10% swing in the positive direction puts us right at $53 a share and would be right at our strike price of $53. So how do we handle this? Here are a few options. Here are 3 options that we can talk about. Option A, this is the break-even pivot where we focus on principal and protection. Option B is the staggered approach where it's a balance of risk and reward. And then there's option C, which is aggressive premium collection with the option to roll. So let's look at these. Option A, we can stop selling the $53 strike and move strikes to $55 or $56. This will protect the principal, but it drastically reduces the income generation. Option B, I kind of like this option, and maybe we'll do it in the future. It's the staggered approach. So it would be selling 19 contracts at the $53 strike for a lot more premium, and then selling the remaining 19 contracts at $55 to protect our principal. It's very balanced. And option C, this one's a bit more aggressive and might take a little bit of luck as well, but it's you continue to sell $53 strikes, and if TQQQ rises to about $52.50 or it gets close to that $53 price, then you buy out of them and you roll up. So basically you buy those calls hopefully for less than what we sold them, and you sell higher strike price calls. So you can sell them at $54 or $55. And the idea is that you collect more in premium selling the $54 or $55 strikes that expire further into the future than the current ones that expire this week. In the last video, I was currently in a trade. I had sold 38 calls at the $53 strike. I collected $2,090 in premium On March 2nd, I bought those back for $17 a contract, which cost me $646. But in profit, that gave me $1,444 in profit, about 69%. Right after I got out of that trade, on March 2nd, I sold 38 calls at the $53 strike. These ones were set to expire on March 13th, and I sold these for $59 a contract and collected $2,242. And today, on March 9th, I bought those back for $7 a contract, which cost me $266. But in total, this gave me $1,976 in profit, or 88%. Since I've been selling a lot of calls recently and collecting a lot of cash, I had a lot of excess cash in my account. So I've been capitalizing on this cash and using it to sell more puts. Last week, I sold 2 of these put contracts and collected $220. I ended up buying them back for about $130, and I collected $90 profit. And then I immediately sold 2 more puts at the $48 strike. These expire on March 13th, and I collected $392 in premiums. So I'm starting to put my extra capital to work to collect more premiums as the weeks go on. And if we take a look at the bottom line dashboard, so far since December 26th, I've sold $33,741 in premiums. I've realized profit of about $27,743. And that gives me a tax bill of about $9,710. And my current break-even price for TQQQ at the $55 strike is $47.68. And this does not include the premiums I've collected from selling the most recent puts, that $398 and that $90 in profit. And if we go back to TQQQ here, the good news is we are actually up right now. Although once we pay our tax bill, we'd probably be down as of right now. But let's go ahead and click on TQQQ here and take a look. And if we scroll down, we could take a look at some of our trades here. So I can just show you some evidence. Click show more. And this is the trade we were in at the last video that I made. I collected $2,090. And then I sold 1 put contract for $105. I sold another one for $115. So average $110, collected $220. And I bought those calls back for $17 per contract, $646. And then I immediately sold 38 calls that expire this Friday, March 13th. I collected $59 per contract, totaling $2,242. I bought these puts back for a total of $130. So I profited about $90 on those. And then I immediately sold 2 more at $196 per contract, collecting $392. And then today, all those calls that I sold, I bought back for 7 cents a share, or $7 a contract, for a total of $266. And if we go back to our portfolio, you'll see I'm currently not in any calls right now. I bought those calls back today for a huge profit, and I never resold calls. Basically, I was trying to be patient to see if the market was going to continue to go up, and I just ended up never selling them. So tomorrow morning, I'll take a look, figure out what I want to do. Maybe I'll do the mixed approach where I sell 19 contracts at the $53 strike and I sell 19 more at the $55 strike. We'll kind of see what I do. Kind of find that mix blend based on what the market is like tomorrow morning and kind of what I'm feeling. If you're trading TQQQ or navigating a wheel position that's underwater, drop a comment below. Let me know your thoughts. How are you managing your strike prices and things like that? Don't forget to like and subscribe, and I'll see you in the next episode. Trade smart.